Welcome everyone. My name is Nathan Bell. I'm Head of Research, and today I'm joined by Alex Haynes, our Head of Distribution, and Wayne Peters, our CIO, and you'll be hearing from both very shortly. We've got a lot to discuss as usual, so we'll press on. I just need to show you the disclaimer, but as you've got a copy of the slides, we'll move through that quite quickly. In terms of the performance, it's the end of the financial year, and basically we in line with the index again, and considering the amount of cash we've held and the slight headwind from the Aussie dollar strength, it's a pretty good absolute return there of nearly 15%. That cash has come down since the end of June. We're down to I think around 16 or 15% because we're starting to find a lot of opportunities away from America, and that's really where we want to focus today. We still have a number of US listed stocks, but the real value we're finding is elsewhere. I'm going to talk about why those reasons are. Our top 10 holdings hasn't changed a lot. There's one new company, third from the top, Fairfax India, and Wayne will be talking about that shortly. And I'll be talking about a couple, JD.com, which has been a wonderful performer since we've owned it in the last 12 months. If only they all worked out so quickly. But again, we're not looking for short-term performance from these businesses. We're trying to find these types of businesses that we're going to own for a very long time to come. So I just had this slide up. We're going to talk about these stocks individually, but just one thing I wanted to, I guess, really ram home with this quarter is that I think we're in a period, or we are in a period now, where interest rates are going up, and we're going to talk about what we think the impact of that's going to be shortly. But there's bound to be more volatility than what we've had probably over at least the last 12 months and over the last 6 or 7 years, really, particularly in the US, where the market's really gone straight up. And I think when it starts to get a little bit rough, people wonder, they tend to gravitate to companies they are very familiar with, and fund managers and companies that they know very well. And I think when you run a global portfolio, because the names of the companies are often not well known to people, they can often come up as people thinking they're the first ones they need to sell. And I just want to really make the point that these companies we're buying, particularly these new names here, are absolute best of breed companies. And there's things that we find in these businesses which we just can't find in Australia. But the most important thing is they're just wonderful businesses, full stop. They're run by excellent management, and we've been able to buy them for what we consider an excellent price. And I think it's very easy in this current environment to think that just because stocks look, quite full, let's say, in the US, which is the market that most people are familiar with outside of Australia. But actually, it's a big world out there, and our portfolio is increasingly becoming much more global, and that's particularly relevant to this presentation, as you'll see when we talk about some of these businesses. So obviously not the most interesting topic for investors. We will get to the stocks very quickly, but I just wanted to make the point that we are in a situation now where I guess people are calling it the reflation trade, but really it's just a change of interest rate policy around the world. The US was the first to move last year, and more recently we've seen Canada move. People have interpreted comments from Mario Draghi in Europe as interest rates are going to head up at some point in the future, and that quantitative easing will be slowly wound down. I think that's going to be a very slow process. But the important thing is the strategies that have worked really, really well since the GFC, these momentum high growth strategies, are going to be questioned when the interest rates start to go up. We know as value investors that you can't just pay any price for any security, and I think these, call them expensive defences if you like, but people are going to start to question the value of those businesses or the prices they've paid when interest rates start going up. And so the way we've structured our portfolio is to try and take advantage of those higher interest rates rather than be caught in the headlights. But I don't think that's the way the market is reacting. And the way the market reaction is just continually to throw more money into these big growth names. The indexes continue to be very strong. But when the market wakes up, and basically the central banks are going to continue to push up interest rates until they get pushed back from the market. But when the market has that the emperor has no clothes moment, I think that's when you're going to see some of these great growth businesses, their valuations will come back to earth, and that's when you're going to really be happy that you own a value portfolio, and that is a portfolio of businesses that are actually supported by their current valuations. And despite what you might think, there's actually plenty of these businesses around, and we've actually been very active in the last few months in particular. I just wanted to very briefly talk about the change in our financials, because you're starting to see a much more Euro-centric approach in our portfolio holdings. We still own Wells Fargo, but I'm just going to use as an example what's been going on in Italy, because if you read the headlines, you'd think the entire banking industry was about to crumble, but actually we're finally starting to see the sort of action that should have been taken 3 or 4 years ago. So if you look at the experience of the US banks over the past few years, they've been cleaned up. They don't have the GFC legacy problems anymore, but you still saw their price to book values were very low because the market wasn't prepared to buy them until they saw interest rates going up. And that's why you've seen Bank of America, for example, double in the last 12 months. And so basically what we're saying here is that's what we're finally seeing in Europe and in Italy in particular. And experience tells you that once the banking system gets cleaned up, the NPLs, the bad debts start lowering, then you actually start to see a real recovery in share markets in those places. And it's the financials are at the pointy end of the curve, but it's just very good for those economies and other businesses in those countries as well. So what you've seen in Italy was recently two banks were euthanized. So essentially they were bankrupt. And what happened was exactly what you would want to happen, and that is Italy essentially balked at the euro rules and came in and offered 20 billion euros to help support the banking system. And these two banks were wound down with absolutely no repercussions in the market. The depositors held their money, the good loans went to some other banks in the country, and the bad loans were taken on by the government, and they will on-sell them to investors at cents in the dollar. So there's been absolutely no disruption to the market, no disruption to deposit holders, and this is exactly what you want to see. And so one of the banks we own, which we bought recently, is called Mediobanca. The most easy way to understand it is it's like the Macquarie Group of Italy. This bank never raised capital during the GFC, which personally I just find remarkable. Pays 3% dividend. It's very profitable. And when we bought it, it was trading at 0.8 times tangible book value. It's only gone up slightly because it's a recent purchase. But as the market starts to price in higher interest rates, and as earnings for the banks start to increase and their profit margins fatten, then we expect to do very well out of a bank like Mediobanca that doesn't have any of the legacy credit issues that many other banks have stemming from the GFC. ING is another one. It sold its insurance business. It sold off its bad debts quite a while ago. We paid around book value, pays a 4% plus dividend yield that's growing. And this is a business that has excellent market positions in Germany and the Benelux or Luxembourg region. So again, these may not be familiar names to you, but these are what we consider very safe businesses, but the market just simply isn't prepared to pay a premium for them for the exact same reason that we saw in America 12 months ago. And that is because interest rates still remain in negative territory in Europe. But when that changes, and we believe it will change over the next 12 to 24 months, we believe the market will start paying a fair price for these businesses. So another bank we've bought isn't actually a turnaround story or a reflationary event or anything like that. This is actually a very unique bank, and I'm going to hand over to Wayne to explain it, but this is an up-and-coming UK retail bank. It isn't a mega bank by any stretch, but that's actually where the opportunity lies. And you may notice just under the headline there of "Love Your Bank at Last." I don't know when the last time anyone told you that, hey, you've got to bank with us or bank with the guys I bank with, because normally dominant banks just have very poor service. That's the same in the UK. It's the same in Australia. And you'll see just under the headline there, it says our stores are open 7 days a week, early and late, pop in and see us. You certainly don't see that as a tagline for Commonwealth Bank or any of the others. So with that, I'm going to hand over to you, Wayne.
Yes, Nathan, you're absolutely right. This is a fascinating story. And the customer service in the UK is even worse than we're generally experiencing here in Australia. What struck us is Metro has been operating now for 7 years in the UK, founded by Vernon Hill, who pretty much played the same business strategy in the northeast of America, around the New York area, with a firm called Commerce Bank. So his business strategy has been laid out for us with the success we're expecting from Metro in the form of Commerce Bank. In the UK, though, Metro was the first banking license issued in over 150 years. So that's how stayed and control the UK banking industry is. And we feel there's an enormous opportunity for Metro and a number of the other challenger banks. I had the opportunity to spend time with Vernon Hill to have the overall strategy explained, because just looking at the numbers on face value, it doesn't really give you the picture of where the potential of this bank lies. And then I went and spent time with Craig Donaldson at their head office and their main store at Holborn in the UK. This store is opposite the tube station, which sees just on 37 million passengers transfer through on an annual basis. But what's interesting is just how customer-centric this bank is. And their target by 2027 is 4% market share, which equates to currently around £100 billion in deposits. And if they get anywhere near that, we expect to make 3 to 4 times our money on this investment now. So again, it ticks the boxes as far as a long runway, a very strong and positive returns on invested capital, with management that have a lot of skin in the game, have proven track record, very customer centric, and exactly the type of businesses that we look to put in the Peters MacGregor fund.
And maybe just quickly, Wayne, when these guys say they're customer centric, this isn't just a tagline. You actually saw this for yourself.
Exactly. I mean, you often pick up the annual reports and they all talk about how they have their competitive advantages and how customer centric the firm is. But it's not until you actually get on the ground, talk with customers, speak with the staff, that you can actually see that in play, or whether it's just a headline. And with Metro, just the tire kicking we did with the competitors and with the staff of Metro, and then with existing customers, and our channel checking just supported everything we were hearing from the bank. I mean, for example, their opening hours are 9 to 5, Monday to Thursday, but they were always open at 10 to 9 and 10 past 5. It's about exceeding the customers' expectations. Opening bank accounts, I mean, what a disaster it is through the 4 main pillars in the UK. You have to make an appointment to go to open a bank account, which could take days, sometimes weeks. And then once you get the appointment, you're waiting 2 to 3 weeks to get your account opened. With Metro, you walk in and you'll have the account open in 45 minutes. So it's chalk and cheese at this stage. And what's quite interesting is you would expect the incumbents to be able to follow suit and diminish that competitive advantage. But the underlying issue is their technology platforms are so old and are carried on the books at such high costs that to replace them, to compete with Metro, which has the latest, would just be very, very expensive. And we don't expect them to react to Metro because it's so small for a long, long time to come.
So it's a very different story to the banks that we've owned, but we've seen Vernon Hill has had the same strategy in the US before. I think over 3 decades, the annualised return for shareholders was 23%. And we think over the next decade, as this basically it's just a cookie cutter approach, as this business just rolls out new stores around the UK, which it shouldn't have any problem in doing, then the strategy is the right one. And we may even get 1 or 2 more chances to tip in some more money as the company grows. So the Chinese technology stocks that we own have traditionally been Baidu and JD.com. JD just keeps going from strength to strength. It had a big day to celebrate, I think it was a 10-year anniversary for the company, had a special sale, and the sales figures were just off the charts. It's hard not to fall in love with this business, but I was just reading a story this morning about how it's using drones, potentially within 500 kilometre radius, to get the deliveries done in rural places in China. There's just an enormous. We found a video of one of I think it's their biggest warehouse in China. I think 100,000 square foot, if that sounds right. And basically, it only took one person to touch a package before little robots, which look very similar to the automatic vacuum cleaners in your home, basically with a tray mounted on them, and then they just went around the huge warehouse and dropped the parcel where it needed to be, and out it goes. So This is a company that's up about 60 or 70% since we first bought it a year ago, but this isn't anywhere near over. This is a company we plan to own for a very long time to come, but no doubt the price will be volatile over time. Baidu, we're still waiting for the growth to come back after the regulatory clampdown on medical advertising. So that's still probably another 6 months before we'll find out whether we've at least made the right call on that one. But the one we've added more recently, which I want to quickly speak about, is Tencent. As we describe it to most people, it's probably the only $350 billion business you've never heard of. It's run by a guy called Pony Ma, and it's most famously known for its WeChat free mobile messaging service, which has 938 million active users. And there's some silly statistics around the amount of time people spend on there, but half of them spend at least an hour and a half on there every day. And the way to think about it is their app is really like having Facebook, PayPal, Uber, Yelp, and Expedia all rolled into one. That's how dominant it is in China. And the China government really does like having its national champions in a way that America doesn't necessarily like to. This is a phenomenally profitable business. This isn't like JD where you've got to invest today and essentially take a leap of faith that the profits are going to come in the future. This is a business exceptionally huge profits already, because it has 50% market share in the highly profitable Chinese gaming market. The next best competitor has 20%, so it's still a very consolidated industry. But this business itself is growing around 50% a year at the moment. They have basically the number one games. And it's all in China. They're trying to do some things outside of China, but I think that's going to be very difficult for them. But they've still got massive opportunities in China that aren't showing up in the earnings yet. Despite how big this business is, only 15% of revenue currently comes from advertising, which is an enormous opportunity. Facebook, you just get pummeled with ads all day. I think it's about, in the West, 50 ads per person per day. In China at the moment, they're only offering one ad per person per day in what they call their moments business, which is essentially the Facebook. So that's an enormous optionality there, and in Tenpay.
Nathan, an interesting fact on Tencent is just 2 weeks ago, they had to bring in limitations for their customers below 13 years of age and below 18, where they limited the amount of time they spent on their games. Now, when you have a product where you have to limit your customer time on that product, well, that's a first-rate problem to have.
And I think the business model too, for people who have been investing abroad before, probably familiar with some of the companies like Activision, which used to have these really long lulls in their profitability as they're waiting for the next hit to come out. But the new online games have basically a subscription model where you essentially pay an annual or monthly subscription, and then as time goes on, you pay more money to improve the game. And this is a far better model, far more profitable model than the old one. So again, it explains that the model has changed, and Tencent are right on top of it and leading it in China. I mentioned quickly Tenpay. This is essentially the PayPal of China, but there's quite a few of these payments businesses. There's Alipay in China, as well as a couple of others. But again, this is a particular division that doesn't make a lot of money yet, but it's not hitting earnings either. So we've paid 37 times earnings for this business, which sounds like a very big multiple for a value investor in particular to be paying. But it's all about what we think the intrinsic value of this business is, and not what the initial price to earnings ratio is. And revenue grew almost 50% last year and expected to do so again this year. So this is a very dominant business, has very little competition, very well run, and again, it's a wonderful business that's very well known, or increasingly becoming well known around the world. So Wayne recently come back from a trip to India, and ironically, we bought our first Indian business, which happens to be listed in Toronto. So I'll hand it over to you, Wayne, Fairfax India.
Yes, so I mean, just taking a step back, clearly, a lot has been written about India. People understand the size of the market, 1.3 billion. But when you dig into it, the demographics really present a very long runway with very high growth rates, which is type of the areas where we want to be focused on. I mean, Modi's policy introductions over the last year are starting to play out and are very, very constructive for business and growth in the per capita income of the nation, which currently sits at around $600. Putting it in perspective, the listed market value of India with 1.3 billion people is just on 70% greater than the Australian market. So enormous opportunities there. But of course, with a developing market as India is, corruption is a very high component of how business is done. So partnering and selecting the management with whom you want to be invested alongside is very important. So Fairfax India is a company that came to our notice through our Fairfax Financial holding, and I had the opportunity to meet the CEO, Ashra Raghavan, in Mumbai recently, and then spend time with the companies in which they've invested. So there are 8 core investments, and today we'll just touch on the 3 major investments to give you a flavour of where our money is invested currently. So their investments are quite disparate, but again, they're being run by first-in-class management, and they're really first-in-class assets which are taking advantage of this long growth rate that we see in India. The Bangalore airport is 48% owned by Fairfax India. Now, this is the 3rd largest airport. It has 22 million visitors going through it yearly currently, and within 10 years they expect those numbers to triple. So, by 2028 they expect the visitors going through that airport to be something like 60 million people, Nathan. It's just phenomenal growth rate. Then the next biggest asset they have, which is where we see the most value compared to the current carrying book value on the balance sheet, is the 2nd largest PVC company in India called Sanmar. And Fairfax India have a 30% equity interest in that, plus they have a $300 million bond outstanding to that business. This is a business that is very cyclical, but it's run by a family that has built this business from scratch. And if you look at the numbers, there is no way you could tell it's a cyclical business, simply because the overall headline growth numbers are just so strong. And this is a business we hope to be invested in for a very long period of time. And then they have a 27% interest in IIFL, one of the major financial planning groups and financial asset management. And again, as the per capita income increases, you'll see more and more people moving into that middle class and needing these financial services that IIFL offer. So very excited about this this initial position. I mean, the stock's already moved 15% from our entry price, but these short-term blips really don't factor into our thinking. We're expecting to own this for 10 years or longer, and we think we'll do very, very well.
And so even though our intrinsic value estimates are well above what we think, or the reported net asset values are for this business, it's not a case of just looking at this business today either. It's about the deals that this company is going to be able to do in the future and add to our earnings, and just continue adding value in the way Fairfax Financial itself has over time. So in summary, higher interest rates are going to impact different countries differently. Places like Canada and Australia look particularly vulnerable to higher interest rates, which again is probably why they're not going to go very high anyway, due to the huge amount of debt in their property markets. We feel Chinese technology stocks offer better value than US technology stocks, with much longer growth runways, in the sense that they're just less mature businesses. We like the European banks better than the US banks. The US banks have already priced in higher interest rates, and the European banks haven't done that yet. And we think Modi's New India is a huge opportunity, but we still need to be selective. So with that, I'm going to hand over to Alex.
Thanks, Nathan. Just a quick business update before we have some Q&A. From 1 July this year, we increased the minimum number of stocks held in the portfolio to 20 and decreased the maximum cash weighting to 20%. These incremental moves reflect a deepening and broadening of our research efforts, and that's resulting in a greater number of investment ideas coming into the portfolio. So we view that change quite positively. Also, we changed the benchmark. Now, the main takeout here is we still have the All Country World Index as a broad-based benchmark. However, we've gone from the IMI variant of that benchmark to the broad-based index, and basically what that means is it removes around 6,000 micro-cap global equity stocks with a market cap between US 20 million and US 220 million that simply we were never going to own. So that's basically the main takeout there is we have a much more relevant benchmark, and our minimum market cap we typically enter into a stock is 1 billion Aussie. If we move to the next slide, let's come through. Our strategies are broadly available for financial planners and their clients on all of the major platforms. Delighted also to have our offering now available in the New Zealand market via Aegis and First NZ. We're rated by Longsec and Zenith. And I guess in summary, as Nathan addressed in his comments regarding the different interest rate and business cycles in the world we face right now, we believe this creates real opportunity for value stock pickers. And therefore, we believe it's important for financial planners and your client's global exposure that you have a quality value manager as part of that mix. And we obviously be delighted to talk to you offline if our strategy is of further interest. So with that, we'll now open up to questions. So we had a couple come through. The first one, oh gosh, I think this one could be for Wayne. Wayne, any lessons from Berkshire Hathaway investments for stock picking elsewhere?
Any lessons? Well, I just, Alex, make one point with the portfolio. People that have watched our portfolio and the stocks that we have in it would note a number of the positions are also owned by Berkshire Hathaway. In every instant, we've held the position before Berkshire has taken their position. So they have followed us into 5 positions over the last number of years, the first being Bank of America, then Precision Cast Parts. Well, they didn't really follow us into the company with Precision Cast Parts. They bought the entire company, and we'd been a shareholder in that business for some time prior. SiriusXM is another position where they've just recently taken a large position, as large as John Malone has in the business. Liberty Latin America, which is our Latin America cable exposure business, and Liberty Global, which is the European cable. So 5 businesses which we hold in the portfolio or have held in the portfolio, Berkshire has followed us in. So that is, that's giving us some affirmation that we're fishing in the right pond. We're looking for those businesses of high quality with the long runways. But the Omaha meeting this year was as constructive as ever. It was my 20th year attending that, and the team and I fronted up, and the networking over the 4 or 5 days is very, very constructive. So it's not just the meeting on the Saturday, but again, the messages are very clear. Forget about making macro calls. Look for businesses that will compete firmly and competitively through any economic cycle, and just buy at attractive prices and sit back and let the management do the work for you. So that's the key takeaway, and our position is very much focused on that.
Thanks, Wayne. Another question: what are the chief market concerns over the next 12 to 36 months, and what are you doing to offset this?
So I would say the biggest concerns out there from a top view is high valuations, which have generally been driven by low interest rates. So as I talked about earlier, those interest rates around the world are mostly heading up from now, although they're still going to end up at a lower level than what they have historically. The problem is central banks don't really know what the natural rate of interest is, so they're basically just going to push interest rates up until they get some sort of reaction for the market. And so to us, it's about avoiding the obvious pockets of overvaluation. So I'd look at some of the companies in America, like I always pick on McDonald's because it's the easiest one. It hasn't grown earnings since the GFC, which I find just absolutely remarkable. They're the same, they have not changed. and yet the price to earnings ratio has gone from 13 to 27. So to me, that doesn't scream value, and those are the sorts of things we want to avoid. But they're also the sort of big companies that people own in index funds and ETFs, which, again, we want to avoid. And probably the other bigger issue out there that gets quite a bit of news is the growing debt in China. And if there was to be some big fallout at some point, which I don't think is guaranteed, because the government can do a lot to slow it down and sort of ease their way through it. And we're actually seeing them take actions at the moment in terms of getting the debt down in their big state operating enterprises, state-owned enterprises. But the way we structured our portfolio is we've bought technology stocks which we would expect to perform even through a recession in the same way that Amazon and Google did through the US recession. It really didn't slow them down at all because the tailwinds blowing behind these businesses was just so strong. So these aren't cyclical businesses, so we don't really need to worry about that. It's really about just making sure they're maintaining their competitive edge and investing for the future. And the other one thing we've done in China is we've hedged the currency, or the Chinese yuan. You got anything else to add, Wayne?
I don't.
Okay. Thanks, Nathan. I think actually we've got one more question that's come through. Can you comment on upcoming research trips and the objectives? Any team changes at all? Question mark.
Yes. Okay. We're currently in the market looking for an additional senior analyst. So we've conducted a number of interviews over the last fortnight. So we're looking to bolster the team. As far as upcoming research trips, we have a trip to China towards the end of August, and I'll be visiting companies in continental Europe and the UK during September. So 2 major trips where the analyst teams are spreading themselves around the world and going to visit prospective companies that we're looking to invest in and existing businesses.
I'd just like to thank everyone again for your attendance today. A copy of the slides and transcript will be sent to you post this call. And of course, if you have any further questions, please send them through to myself or Matthew or the team. We'll be delighted to address them for you. Thank you again.